Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 255th podcast VideoCast for the week ending September 5th, 2024. A lot of great stuff to cover. First, we'll start with family, then we'll get right down to business. This is Mimi and Annabelle with our dogs, Lucky and Pepper, at our local ice cream place, Chocolatier. That was before they headed off to California for the next 4 months to train seriously for water polo and swimming. Very excited. That's Mimi with her new water polo club. That's another picture with the girls with the dogs. That's me proudly wearing my Junior Olympics water polo hat from this year. And that is Mimi on her first day of training. The lady in the white shirt is Olympian Maggie Steffens, directly training Mimi. So we're excited for the next 4 months. They'll be out there training like crazy. I'll be out there tomorrow, Friday through Monday. Any clients or potential clients that want to grab a coffee, I can definitely take out a half hour or so. The rest of the time I want to spend full time with them when I'm not working, and I'll be going back and forth for the next 4 months back in New York on late Monday night. So that's that. And then finally, my golf swing is actually come back. I'm striking the ball really well. Booking a lot of 41s and 43s, but just not putting them together yet for 2 times in a row. But back in the right gear and pretty excited. I think I'm going to dial that in and get it done before the end of the year. Want to thank, now onto the media, want to thank Preston Mizell, Christian Dagger, and Stuart Varney for having me on Varney and Company on Friday. We talked about Intel, which is a very controversial stock right now. We're not going to go into a lot of it because there's going to be a board meeting mid-September. There are activists circling around this stock, and once we identify who they are and their track record of turnarounds, we're going to ride that train. And they're selling off Mobileye. They just announced, thank God, what took them long enough. They probably won't do the Germany factory, which is perfectly fine. We care about the U.S. factories, and and they're swirling about getting rid of Gelsinger. I'm kind of, I'm not really in that camp yet. I know everyone wants to blame Gelsinger, but let's see what happens in the next few weeks. It's trading at tangible book. What does that mean in English? If they were to liquidate the company today, in other words, they're attributing no value for the organic growth of the business. And we spent 3 hours explaining why that was a false narrative. But that creates the opportunity to buy down here, which we took advantage of. So let's tune into Stu.
Pre-market action on a Friday morning, right before a long holiday weekend. Solid gain for the Nasdaq. Look at that, up 166 points. That is 0.86%. Tom Hayes back with us to look at the markets this morning. All right, margins, profits and profit margins have been good this earnings season. Does that mean the rally continues?
I think the theme here, Stu, is stay alive till 2025. What do I mean by that? The music's playing right now. We're going to dance until that first cut, which is usually historically a buy the rumor, sell the news. So we might get a little choppiness before the election. That's also in line with election year seasonality since World War II. So if you're on margin, if you're on leverage, come off margin and leverage, stay invested, enjoy the volatility in October, and we'll get a year-end rally once we know that gridlock is in. Regardless of which party wins the executive branch, we just want to see gridlock. The less politicians can do, the better for the stock market.
You love some gridlock when you, so it does well for the market. That's
Absolutely.
True. Now, you've got 2 stocks that you like. I want to start with Generac,
Yes.
the generator people.
70% of the market, the stock is down 70% from its COVID highs. Why? They over-inventoried because they thought they couldn't get parts. They worked through that inventory. It troughed in the 4th quarter of last year. It's re-accelerating. It's up off the lows of $70, $80. It's up to $155. We think this can go much higher. This was a $500 stock.
Yep.
They'll be generating similar cash flows within the next 12 to 24 months that they were at their peak. Interest rates lowering is going to help this because people finance the purchases. And we've got hurricane season right right around the corner. So that's good for Generac, 70% of the market.
Yeah, and the grid ain't doing too well, is it? So
That's
it's nice
right.
to have a Generac in the backyard.
You got it exactly.
Okay. The other one is Intel. I noticed that it's got to 21. I say this every day. Intel's got to $21 a share, or it's reached 20. Is it a buy?
It is a buy. You know,
It's come down a lot.
It's trading at tangible book, okay? The government has backstopped this. They need Intel's foundry to succeed to compete with Taiwan Semiconductor. So they've given them money. They're going to stand behind the foundry. And they announced today they might separate the foundry business. They're going to be activists around this stock. They've hired someone to defend against activists, which means stuff is going to start to happen. So they've got their legacy business, the AI PC business. They're going to ship 40 million. They're still a leader in that business. And the Gaudi 3 competes with the NVIDIA 100 chip. It's half the price for twice the performance, 40% more energy efficient. So if you think NVIDIA is going to have a monopoly on this, think again. We've gone through the semiconductor cycle. Sooner or later, it becomes a commodity product. Intel's going to be able to compete and chip away at NVIDIA.
Going to get back to 30 or 35?
I think over the next 12 to 24 months, this stock can get not only to 30, I think their legacy business, excluding the promise of GPUs, I think their legacy business alone is worth $40 a share.
Okay. Well, take a look at it.
Thanks so much,
Tom Hayes,
Stu.
thanks for being here. Appreciate it.
And we're back. And then I had the pleasure of joining Sean Caleb's on CGTN America. Thanks to Sean and Tufik Gibran for having me on. We'll listen in here.
Okay, a lot to unpack talking about the U.S. economy, and for that, we turn to Thomas Hayes. He is the founder, chairman, and managing member of Great Hill Capital, an equity management company based in New York. Thomas, great to have you on. I certainly appreciate it, and a lot, as I mentioned, to get to. Overall, the report, very encouraging. I want to get your takeaway from it. American consumers obviously spending. Do they have the money? What about this latest data? What are the bright spots, and what areas, if any, do you think are out there for concern?
Well, the good news, Sean, is that when the U.S. consumer has a job, they spend money. You never want to bet against the U.S. consumer. What we are seeing in terms of mixed results is companies like Dollar General that cater to lower income consumers are really getting hurt. That stock had its biggest one-day drop, I believe, ever today.
Wow.
Because the lower-end consumer is struggling a little bit. You're seeing with the lower-end fast food restaurants in the value wars trying to offer lower and lower prices for those consumers that are hurting the most. And then at the upper ends, you saw Best Buy today have one of its best days ever because more and more people are buying AI PCs and refreshing their PC cycles. So it's a tale of two cities, but on balance, we saw with that GDP number, things are generally okay.
Let's talk a bit more about the tale of two cities, because anytime you have a wealth gap, that's obviously a reason for concern. What about the do-it-yourself operations, Home Depot, entities such as that? Because frequently, when times are tough, people will try to do it themselves rather than hire out a contractor. Do we see anything like that?
Yeah, I think these will do well. They're kind of insulated. Their businesses are broad enough. But what's really going to benefit the Home Depots and the Lowe's of the world, and even some of the companies that are suppliers there, like the Stanley Black & Deckers, the Generac, is lower interest rates. That is going to reignite housing. That's going to reignite projects. That's going to reignite construction. That is a big deal that's coming to a theater near you. The Fed is going to start cutting in September, and they are going to be one of the initial immediate beneficiaries.
Well, for all those folks out there who do work construction, that's great news for them. Let's talk about the data for the labor markets as well. Clean energy jobs doing well. But what's the overall state of the labor market right now, especially given other recent information that shows the U.S. economy simply did not add as many jobs, any kind of jobs, good jobs or however you want to classify it, as previous readings?
Yeah, that was a big shocker for a lot of people, the 818,000 downward revision over the year. What we're finding, though, is the Fed has a dual mandate, and they've now shifted their focus. They were exclusively focused on inflation. They have now shifted, and what's caused them to move is their concerns about the labor market. the initial jobless claims that Karina mentioned,
Right.
while it came in better than estimated, they are elevated, and the Fed has their eye on it, and that's why they're going to go in September, because that is a lot harder to recover once it starts falling apart.
Okay, we also know wages have coming up in the past year or so, but the price of groceries has gone up 21%, the price overall of goods about 19%, but still the economy has been boosted by this consumer spending. It comes as a surprise given the prices that I just talked about. So what is driving consumers? Is this their confidence out there that we're going to turn the corner?
I think there's something to that. Number one, they have jobs. Number two, they are deleveraged. If you look at the deleveraging debt service as a percentage of disposable income, it's really fallen off of a cliff since 2009. It's come down and down and down. The moral of the story is people have a lot less debt. They have a lot more cash. And albeit there is a demographic at the lower end that's starting to struggle, and we're seeing defaults spike up and auto loans and things like that, by and large, 80-some-odd% of the population is doing generally okay, but a little bit worried. And that's why the Fed has taken a move. They don't want to see layoffs start. There had been some data out 2 weeks ago that the unemployment rate, if you back out the immigration, could be as potentially as low as 3.6, 3.7%. It's the immigration that has caused the 4.3% print as of present.
You know, we really can't talk about all this new data without talking about the upcoming U.S. election. Kamala Harris has made it clear she really wants to target price gouging. Donald Trump has been looking overseas, wants more tariffs, especially on China coming in. What are your thoughts on the U.S. race? What are people looking at to distinguish themselves from an economic standpoint from these two candidates?
Well, look, the name of the game is, as it relates to stock markets and generally the economy, is everyone does better when there's gridlock, i.e., no one party has too much power. So as it relates to taxing unrealized capital gains, that's a bad idea. If I was going to write a book called How to Cause a Great Depression, the first chapter 1 would be entitled, Let's Start Taxing Unrealized Capital
But
Gains.
isn't that something, but hang on a second, isn't that taken out of context to a degree? Because as I understand it, it's just aimed at people who have $100 million or more.
Yeah, and the people that have $100 million or more are the people who invest in companies that create jobs. And if you take away their incentive to invest in companies, you're going to have a lot less jobs. So I don't think that will get through Congress, so I don't think that's a material thing. As it relates to Trump, on the other hand, threatening tariffs, he did the same thing in his first term. What we saw was that Chinese relations, certainly Chinese stocks, did a lot better under the Trump administration than they did under the Biden administration. They actually had one of their worst crashes ever under the Biden administration. So I think the jury is out. Oftentimes, if you make bets based on politics, you lose. Everyone thought energy stocks would do well under Trump. They underperformed. They did well under Biden. Everyone thought solar stocks would go to zero under Trump. They actually did quite well. They did poorly under Biden. So I wouldn't make your bets on politics. I would make your bets on the fact that earnings continue to grow. Estimates are up for plus 15% for next year. So on balance, as long as we have checks and balances and one party does not win all three branches, we're going to be just okay.
Okay, Thomas Hayes, good stuff as always. We can't thank you enough. We appreciate it.
Thank you, Sean.
And we're back. And then finally, I got a call from Mike Larson. Wanted me to join him on the Money Show podcast this week, which was phenomenal. Really enjoyed talking with Mike. He always puts out great stuff. We're going to listen in here.
I think we're setting up very close to a situation like 2001 to 2007 where tech underperformed. We're not going to crash like we did back then because they actually have earnings power, but underperformed. And as some of these groups outperform as the dollar weakens.
Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show. 2024 has been a strong year for the stock market. We're seeing a lot more volatility in August and September to date. We have a huge list of potential market catalysts right around the corner. That includes the first likely Federal Reserve interest rate cut in 4+ years, and of course, the upcoming presidential election. Joining me to cut through the clutter and give you some actionable opinions about what is likely to happen is Tom Hayes. Tom is founder, chairman, and managing member of Great Hill Capital, as well as the man behind the informative and entertaining market commentary site, Hedge Fund Tips. Tom, how are you?
I'm doing great. Good to be with you, Mike.
Yeah, I'm glad to have you here. I mean, geez, a lot going on in the market. So I guess I kind of have to start with the most obvious question, right? Is September going to be one of those moments where we all want to run and hide, or do you think this seasonally weak period for markets talk is a little bit overblown?
You know, it's interesting. When everyone's looking for a correction is when you usually don't get it. You know, we've been of the view that it could get a little choppy in late September and early October. I think the potential surprise here, Mike, is that the jobs report should come in a fashion on Friday that will cement the Fed doing obviously the 25 basis points and maybe 50 basis points, but more likely 25, no matter how bad the jobs report is on Friday. And we've got two coincident factors. Number one is the election year seasonality. If you look back to World War II, it tends to actually be, markets tend to be strong into mid-September, not September 1st, mid-September. That doesn't mean it's going to work exactly that way this year. But the other thing that we notice is when a Fed starts the easing cycle, the first cut has a high propensity to be a buy the rumor, sell the news. So our base case is actually that we start to see some strength into that first cut. So, you know, maybe yesterday and today being a one-off, the short-term volatility, we get the jobs report, people start to look forward to the cut, and maybe we even touch, you know, we did with the Dow, or relook at near new highs on the S&P, and then we move into that normal pre-election jitters from late September through the end of October, which will be an opportunity to buy into a year-end rally that is fostered by a hopeful gridlock outcome, irrespective of who's elected. Not having one party with absolute control is the key for the stock market.
Got it. Well, let's talk a little bit about the Fed and kind of the economic news. I mean, as we're speaking, we just got a pretty lousy looking JOLTS report. You know, we won't have the NFP by the time this airs, but we've seen some squishier, softer numbers, not terribly recessionary, in my opinion, of late. So how do you think the Fed reacts? What do you see them doing again in September, and maybe as we roll into the final couple of meetings here in 2024?
Yeah, Jay Powell has a history of not liking to shock markets. I think he learned that early on in December of 2018 when he said autopilot. And by Christmas Eve, everyone was wondering if the stock market was going to fall through the floor. It fell something like 19%, like overnight. I was at Disneyland looking at myself. I'm like, what the hell is he doing? And fortunately, Mnuchin stepped in and got the banks together and recovered everything. So since then, he tends to avoid major surprises, and on that basis, I think he's going to do 25, even if the jobs report is weak. And from there, we could see the market's pricing in 100 this year. I don't know. You know, that would kind of concern me in the sense that if they do a 50 cut, maybe the economy is a little worse than everyone expects. Maybe it's not a soft landing. So our base case is actually more conservative, 50 to 75. I think 75 probably gets done 25, 25, 25. Yep. And then we see where it is in 2025.
Got it. You know, one of the things that obviously I follow your work at Hedge Fund Tips. It's fantastic. Everybody who's watching this, please make sure you sign up for some of that commentary because it's very insightful and enjoyable. One of the things I know you've been talking about there and elsewhere is the rotation that we've seen in this market for the last couple of months, right? I mean, it was an all tech all the time market for a while. Since July, that's been changing. I mean, what do you think is going on there, and what do you think that means going forward?
I think it's very, very healthy. The market is broadening out. And it's not just some hope. Like we've had some fake outs in the past. This time it's actually backstopped and substantiated by the trends in earnings. You know, you had the Magnificent Seven earnings growth in the first quarter of this year was 50%. That's dropping down to 18 to 20% by fourth quarter of this year. And year on year, it'll go from 30% this year to 18% next year. At the same time, the unmagnificent 493 in the first half of this year had negative earnings growth. So when people say, well, why are only 7 stocks performing? Because only 7 stocks have meaningful enough earnings growth to perform. That is changing. That's now inflecting to positive earnings growth. And that's why you're starting to see the broadening. That's why you're starting to see the movement under the surface. Small caps, for instance, expected to grow 7% earnings growth this year. How about 37% earnings growth next year? And that is also in line with the first 6 and 12 months after a Fed cut. Value outperforms growth in the first 6 months, and small caps outperform large caps by over 11 percentage points in the first 12 months after the first cut from the Federal Reserve.
That's some great insights there. And I wanted to ask you, while we're on that subject, within sort of the small cap space or some of the non-tech sectors, what looks particularly attractive to you? I mean, is it financials? Is it industrial? Something else that you're watching?
It's across the board. We specialize in turnarounds. My nickname is kind of Turnaround Tom. One company that's not a small cap, it's not a dividend pair. The groups that tend to outperform after the first cut, we've got a weakening dollar, we got lower rates. So that means emerging markets should do better. It means small caps should do better. It means dividend payers should do better. And it means value should do better. And I think one of the stocks that has become a value stock is called that we own is called PayPal, and we own it lower from these levels. It's had a recent move, but we think just getting started. And the name of the game there is 490 some odd users around the world. But more than that, why is the stock down? Why did the stock fall 80% from the COVID highs? Is because margins were compressing, and they got this new CEO named Alex Chris. He came from Intuit. He ran 50% of the revenues there, the small business division. While he was there in 10 years, the stock was a 38 bagger. He's going to apply some of those principles to PayPal. And the first thing that he's focused on is something called Fast Lane. So you have a business at the Money Show. And what if I could tell you that instead of having 50% conversion when people check out to buy a ticket, it goes to 80% conversion, and it reduces the amount of time that they're on the site and closes the conversion that much faster. Would you be willing to pay Braintree or PayPal 2.2% take rate versus 2.0% take rate if your conversion went from 50 to 80%? Would that make sense for you as a business person?
Yeah, sounds exciting.
Complete no-brainer. And it's gotten so good that it's not even just PayPal using it now. Their competitors like Adyen, which is one of the biggest payment processors in Europe, is now licensing the Fastlane checkout from PayPal. Fiserv, which is a multi-billion-dollar company, is licensing that service from PayPal. So what's happening? Margins are reaccelerating. And he came in and cleared the deck. He's barely coming on 1 year. And, he basically took expectations down. He said, we're going to do $5 billion of free cash flow. We'll buy back $5 billion of stock. Well, he just came out this quarter and has said, that $5 billion, I got that wrong. We're actually going to generate $6 billion of free cash flow this year. And we're going to buy $6 billion worth of stock. Then you got this other business called Venmo, which is basically the Kleenex of peer-to-peer payments that's growing like a weed. They've got a Venmo for teens that's growing like a weed, and there's a lot to do there. So it's really just the beginning. So some of these fallen angels are really a tremendous opportunity here.
I love that you brought up the Turnaround Tom nickname. I'm going to get to that in a second towards the end, but I wanted to ask first, you've been a proponent of some looking outside of U.S. borders at some of the cheaper stocks you can find around the world, even in a place like China, which had fallen out of favor for a long time. Are we at the point where those types of markets are going to play catch up here? If so, why? And what would you do about it?
Yeah. So two things. 100% dollars weakening, yields are coming down. That is a magic formula for emerging markets. I think we're setting up very close to a situation like 2001 to 2007, where tech underperformed. We're not going to crash like we did back then because they actually have earnings power, but underperformed. And some of these groups outperform as the dollar weakens. So China, we want exposure. And look, we've been bagged in this Alibaba for a year and a half. It's been dead money, completely done nothing. But I think the time is now. And Alibaba is a proxy for emerging markets, but more than that, a proxy for China. It's the national champion. And something very important just happened. The shareholders voted on August 22nd to approve a dual primary listing in Hong Kong. That enables it to join the Southbound Connect on September 9th. What does that mean? It means for the first time ever, mainland China investors, and there are 220 million of them, they anticipate about 180 million as a potential market to buy Alibaba stock, will be able to buy Alibaba stock for the first time ever starting September 9th. What's more important than that is that Alibaba's got about $80 billion of cash on their balance sheet. And rather than, they couldn't get that cash out of China to do buybacks, so they would have to issue non-dilutive convertible stock in order to get US dollars to buy the stock back, even though they had $80 billion sitting at home. They will now be able to buy back stock through the Southbound Connect. And you see just in the last few days since that dual primary listing was approved, that they're reporting how much stock that they're buying back. And we're going to see that accelerate. So I think, look, everyone feels that China's uninvestable. But if you look at the Hang Seng for the last 20 years, you have these huge corrections every 2 to 4 years. And the bigger the correction, the longer it takes. Usually takes about 2 years to build the base. But when it turns and it starts to move up, it tends to be parabolic. And, you got to keep in mind through all the noise, the country's still growing at 5% GDP. And here we are, American exceptionalism, no question about it, but we're growing at 2.5%. So there's opportunity there. They will recover. And I think demographically speaking, they've got another huge parabolic run before maybe they do run out of time 3 to 5 years out, like Japan did in the late 80s, because they didn't make enough babies for so long. But for now, they've got a huge portion of their population age 34, and their spending should increase and peak out at around age 40.
Got it. Tom, you're going to be joining us for the 24 Money Show Masters Symposium in Sarasota this December. We talked about this sort of turnaround approach. I just want to know, when it comes to methodology, why do you find that style of investing so attractive? And what do you think people who are looking to be value investors or turnaround investors need to know when it comes to pointers or advice?
Well, number one, a stock that falls 90% can fall another 50% before you get a 5-bagger. So it's there's something to be said there. But what we like is we're not predict the next great thing people. We are buying durable business that have been around through many cycles and have had multiple turnaround situations and have proven they have a durable moat. So even when the stock's down 60 or 80% or whatever it happens to be, when we're getting involved, we're looking and we're saying, okay, well, the free cash flow and the revenues are kind of holding in there, or in some cases, they might be down modestly. They're not down 80%, that I can assure you. Your revenues are usually flat or growing, and free cash flow is usually positive. And then you get some catalyst with a new CEO that has talent to take this beautiful legacy franchise that has been through multiple cycles over decades and turn it back into something great. And we like it because the margin of safety is much greater once we have comfort with the balance sheet, et cetera, that we can make a double or triple in a handful of years versus business that's already up quite a bit. We had talked about, you may have caught our note in June of this year when we said NVIDIA was the new pain trade. You can look it up on the website. It was like June 22nd. That day, it opened at 136. It went up to 140 against us and has since fallen about 30-40% because it's a great business, but at $3.2 trillion valuation, when you have a total GDP of 28 trillion and an expected growth rate from the sell side of 40% a year, what they're basically trying to convince you is that it's going to be half of GDP in 4 years, which is absolutely makes no sense if you're interested and believe in something called math. So, so those are the type of things that we avoid, and other things that we can have a sense of certainty 2-3 years out. We can make a double or triple. If it's a smaller business, sometimes we can make a multi-bagger.
Got it. Got it. Well, just one last question, I guess. Beyond what we've talked about here, any other sneak peeks or, tidbits about what you think you might be talking about in Sarasota? I know December's still a few months off, so it's a little bit tough. Who knows what the market will do between now and then?
All I can tell you is in the unmagnificent 493, there are tremendous opportunities still that have been created by a once in 100-year event called COVID. And these are durable multi-decade franchises. So we're going to talk about a few of our ideas for 2025. We're very excited about that. We're going to talk about our general market outlook, and we're going to have a lot of fun.
Great. Well, Tom, listen, thank you so much for your advice and your insights here. Viewers, if you're watching and you want to learn more from Tom, he is going to be joining us at that Money Show Master Symposium in Sarasota. It runs December 5th to 7th at the Hyatt Regency Sarasota here in sunny Southwest Florida. If you've been to this part of the country in December, you know how great the weather is going to be. It's going to be a wonderful time. Enjoy the outside, enjoy the knowledge you're going to get inside, and learn from experts like Tom. So click the link below, look at the description if you need some more details. And Tom, I look forward to seeing you there in a couple of months.
Thanks, Mike. And one final caveat, opinion, not advice. Thanks so much for having me.
Got it. Sounds good. Take care, Tom.
Bye-bye.
And I want to go through a couple of things now that we've, as many of you have been following us, we bought a lot of Amazon in October of 2022 and then again in March of 2023. That has more than doubled. We took off the majority of the position in July, as we talked about on the podcast, and we've taken off the rest of the position in the last week. So, blended out of the thing somewhere around 190, and we got in down here. So that's more than a double in a year and a half. And some of these things, they like this one only took, basically a year and a half. Some of these work really, really fast, and others work more slowly, and that's the name of the game. Well, let's look at another that we harvested. We talked about we had sold out of Bank of America. I mean, this was nearly a double off the lows, and we took off the final 25% around 40. So blended, 41, 2, 3 range, and that's not quite a double from the lows, but that was a good trade. And then Citi we're fully out of. This was a monster. Lows were 36 and change. We had some in the 30s, some in the low 40s, and took off most of that and took off the rest this week at in the around 60. So that was close to a double. And again, this one was less than a year or just a little bit over a year rather. And whether it's, so you just see over and over the framework works. Sometimes it takes longer, sometimes. Okay, now Google is one that we took off the majority of the position again in July, perfectly timed right after we put that article out on NVIDIA where we said the next pain trade, and we had the picture of Jensen Huang signing some fan's breast with his signature. And the stock that day opened at 136, went to 139. It's since collapsed close to 100. It's bouncing around the bottom. So we got out of most of Google at that. We still have that 25, 30% tiny small stub in Google. We're not going to sell down in the hole here, but on the next strength up to 170, 180, maybe it makes new highs if we get a rally into the first cut, but I doubt it. We'll probably extinguish the rest of that position. So again, you see here late October 2022, and then again in March of 2023 when it was down at 90, got up to 190 when we were talking about it in July, 180, and now it's at 160. Again, no matter where you slice it, more than a double, year and a half. The framework continues to work. SMTC entered below 20. We took off the full position with a 4 handle, some in July, some in the last week. Same with C Limited. The reason we took this one off, that one has gone from 32 lows to 83 and change. We don't like the business enough, and we have enough exposure to Asia e-commerce through Alibaba, so we just booked that. And then 3M, we already told you. This has been a monster. We got out of this at 125. It went up to 135. Now it's back to 130. Would we consider rebuying this below 100? Yes. May we get that opportunity? We don't know. But again, this is a huge move in a relatively short period of time, and you book the win. So the framework works over and over and over, and sometimes it goes against you before it goes for you. As a matter of fact, every time it goes against you before it goes for you if you're doing a good job. And so just some updates there. Now we've got a tremendous amount of data, and now we've got our new batch that are bouncing around the lows, and they're going to be our next batch of harvesting in the next year and a half. We're going to be doing this type of stuff for those of you who have been following along, and it's just going to work. I mean, 3M looked like it would never work in a million years. By the way, we still own all the Solventum that we got for free, so that's exciting for that. And all right, so sentiment survey data, this came in at 45% bullish, 24% bearish. So look, there's some bullishness. It's being taken out of the market. I think look, it all comes down to the jobs report. I think the jobs report is going to come in weak enough to give people no doubt in their mind that the Fed's going at least 25, possibly 50. I don't think they go 50, as I talked about with Mike, because he doesn't want to shock the market. But I mean, if it was unbelievably weak, they might do 50. That would probably not be good for the market. I think it's going to be Goldilocks, not too hot, not too cold, enough to guarantee the 25. And if that turns out to be correct tomorrow, and maybe the unemployment rate goes from 4.3 to 4.2 as expected, we get the 25. It looks like the world's not falling apart. And I think we probably see equity strength into the first cut, which would be a week and a half, 2 weeks of super strength to suck every last person back in until we fall into some serious seasonal weakness, both from an election year standpoint and to sell the news. So we will use any of that strength to raise some more cash from some of our winners and be ready to either tactically hedge or have that cash ready to deploy in late October, early November, right before we get the election clearing up. An end-of-year monster rally is our expectation. Auto sales volume, thanks to Alan over there. You know, here is August numbers. August numbers to be announced. So they have been moving. You know, they were at 15.8. I think they're at 15.1 now, which is not ideal. But what do we have happening? We have rates coming down, starting in 2 weeks, and you have incentives going up. And as we move to the end of the year, because of all the EV inventories and all that stuff, they're going to just fire sale it and start doing 10, 15, 10, 12% incentives, certainly on the EVs, and probably 8, 9% incentives on the regular cars, which means in round terms, a $50,000 car is going to cost you $45,000, and rates are going to be lower, and they're going to incentivize that in anticipation of maybe 100 basis points lower. So, you know, you could see a situation where as we move towards the end of the year, you see a lot of car ads that look something like this. MSRP 50,000, 5,000 incentives, net 45,000, 2.9% APR. And that's going to get people off the couch. That's going to get a lot of inventories flushed through, and that's going to get production ramping back up, which is what we need to see to get the operating leverage humming in Cooper Standard, which we will. U.S. market breadth is improving. Relative performance of S&P equal weighted index has risen from the lows. That's why a lot of these names have been big winners for us, and we are going to look at that city chart. That's amazing. and we have harvested those 3M. I mean, it's exciting to see those working, and I'm more excited to see the ones that we have are going to be much bigger in aggregate than even those. Election years are different. Average Dow Jones Industrial monthly return since 1896. Don't love going back to 1896 because the pre-World War II data tends to be skewed. However, what they're implying here is that in all years, including election years, September is negative 1% on average. In election years, it's better than it's a positive month, barely a positive month, but a positive month. So that's that. Okay. What 2024 looks like a lot like 2023. That's from Dietrich over at Carson. I don't think that's really relevant, but it does look similar, in which case it would be weakness into the end of October, which is our base case, followed by a super strong year-end rally. I just think we're going to see a little bit of strength before that first cut, and the catalyst will probably be, my guess, is tomorrow's jobs report. So here is more seasonality from 1976 through 2023. This is a presidential year, and you do see a big pop up here into mid to late September before the rollover into late October prior to the election. And that is more in line with how we're thinking about it. Let's see what happens. August does well in election years. Yeah, we know that. But so what they're saying here is September is a little weaker. And that would be correct. That also allows for the rally in late September and then a rollover before the end of the month, which is what we like. Here's more good data from Carson. This shows that you do get this like early weakness and uncertainty, and then a rally oddly into the 19th. The Fed meeting, I believe, is the 17th. So this would be a natural moving back up to highs. And then you just roll over after the 19th, which is kind of how we're thinking about it. Does that mean we sell everything, risk on, risk off? Of course not. Most of our stuff now that we've new positions that we've been able to put on, it's so cheap. It probably rallies when the market gets weak because money has to go somewhere as it rotates out of the Mag 7, which will cause the market to be weak in October because of the weightings. GDP revisions from initial percentage. Consumer spending was the big thing that revised GDP up to 2.5%. So everyone's saying that the GDP, the consumer's dead. It's not fully reflected. I think in the case of, the companies that have been hit, Dollar General, Dollar Tree, Advance Auto Parts, by the way, for sure, by the lower end consumer, I think that was largely due to mismanagement. The difference between Advance Auto Parts and Dollar General and Dollar Tree is Advance Auto Parts has a new jockey that's turning it around. And what's comical about the way the stock is acting right now, and we've taken advantage of it, is that what Shane O'Kelly did in the last few weeks by selling off Worldpac is he took solvency risk off the table. In other words, bankruptcy is off the table, okay? And the stock was down from whatever, 250 down to 60 or 50. Now it's in the 40s. With comp store sales rising, by the way, and they're going to be using that money not just to pay down the debt, which takes solvency risk off the table, but to start to grow 100 new stores a year, get back growth. They've stabilized the existing business. The market didn't like the soft guidance for the next 2 quarters. Same as Disney. They didn't like the soft guidance for the next 2 quarters. Same as Dollar General. Same as Dollar Tree. But it's temporary, not permanent. And don't count out this consumer. As long as the Fed's not too late, and we believe so long as they go the 25, our base case is 25, 25, 25, I would not be surprised if we do 75 to 100. And even though inflation is only, is much lower, I wouldn't be surprised if they don't have to do more than 75 or 100, because I think inflation is going to oscillate between 2 and 4 and 4.5% for the next 3 to 5 years. And they could probably hold the Fed funds at 350 to 4 and get away with it. And that's the environment actually that value does well as well. So, consumer spending contribution to GDP growth, services, good. Oh, this is really interesting, ladies and gentlemen. This is what I was talking about, destock, restock. Goods demand is coming back and normalizing after it went negative in the first quarter. It's back. So that was our trough base case, which was in fourth quarter of last year. Initial jobless claims climbing up. That's why the Fed is taking action. Let's see here. Yeah, consumer spending still a big part of it. S&P monthly returns going back to 1928. Again, this really pre-World War II data is not terribly helpful, with September being the worst month. That's from the Motley Fool, down negative 1.17% on average. U.S. pending home sales at historic lows. What's going to change very quickly to change that is, here's the thing. A lot of people have an enormous amount of equity, boomers, trapped in their houses, and they can't get out because they don't want to trade a 3% mortgage for a 7% mortgage. Well, what's going to happen is mortgage rates are going to drop into a 5 handle pretty damn quickly. Maybe it's 5.9. It doesn't matter. It's psychological with the 5%. And while they weren't willing to do 7%, they're going to be willing to trade 3 to 5, particularly if they book a 7-figure profit on a house that they bought for, an apple pie and 2 slices of ice cream 40 years ago is now worth a couple mil. And maybe they've taken $1 million of equity out at 3%, and they can book $1 million and then buy a townhouse for $1 million cash or finance one at 5 and change and invest the $1 million of profits. And live happily ever after. So the thing where I think they're going to get hurt that most of them don't realize is that as rates go down, I think there's going to be a mad rush of supply pushed on the market, massive amount of supply. And for those who think, well, my price is going to go even higher as rates go down because it trades like a bond, I think they're going to be surprised that they're going to have an enormous amount of competition with so many houses coming on all at once. U.S. pending home, which is good for the people trying to buy houses. U.S. pending home sales tumbled to record low in July. That's going to change very quickly. Japanese CPI going back up, which means BOJ going to be hiking, which means yen going higher. Won going higher, dollar going lower, Japanese equities probably going lower. Chinese yuan, strongest against the dollar since the beginning of the year, moving in the right direction. This is what we see when Chinese equities start going up. Chinese exports up 2.6% since October 2023. Where? It's going to the rest of the world. They are much lower to the U.S., but they are holding steady to the rest of the world. So the rest of the world benefits from their sweatshops while we are not benefiting as much. That's a little bit of an exaggeration, but I also think that's probably related to, believe it or not, automobiles. We're not allowing Chinese cars in the U.S. anytime soon. Germany's shutting down factories because they're letting the Chinese cars in. So we'll see what happens there. I think there are going to be a lot more tariffs coming to a theater near you against the Chinese cars. Economic grievances fuel protests in China. This is what we need to see to cause bazooka type stimulus. And we're going to show you some of the things they've been doing in the last week top 10 cities for economic protests, Shenzhen leading the way. And you can go down the list here. Protests linked to China's former real estate giants, Country Garden, Evergrande, etc. The natives are getting restless. Moving on, private clients bought REITs, financials, MLPs, so opinion follows trend. They're dumping out of Japan, rather. Not China. There's no one left to sell China. They're getting out of Japan. Buying financials. What were we doing? Selling financials to you. And Fed easing history and S&P price return. So everyone says that when the Fed eases, you get a recession. That is not the case. You did not get one the 3 times in 1980s, 80, looks like 83, 85, 87. Market went up. Same thing with the mid-cycle cuts in 95, 98, same thing. And I think we're going to be mid-cycle here. Probably the closest thing to this would be 80 to 83. We got the recession like in 2020 and 2022. And then the second one, 83, easing cycle, paves the way for bull market and good things to come. Fed easing history and 10-year note yield. Well, while equities go up and mid-cycle cuts, bond yields go down every single time. So we like that. That's part of our core thesis. Treasury yields stay down, dollar goes down, emerging markets go up, dividend payers go up, small caps go up, value goes up. Mag 7 moderates. We've already started seeing that. U.S. real consumer spending trends continue to go up. Services, goods, durable goods are rocking and rolling again. After a huge trough, they had the huge peak off the COVID lows. Then they troughed for multiple years, and now they're picking back up. Cars, washing machines. We keep keeping an eye on Whirlpool. That's one in our sights. That'll be a function of the housing recovery, and we're kind of levered to that with Generac and Stanley Black & Decker anyway. Fed favored inflation, although Generac 200, anyway. Fed favored inflation gauges mild gain, set stage for rate cut. Okay, consumer inflation expectations are at multi-year lows, both on the 1 year expectations below 3 at 2.8. 5-year inflation expectations at 3. City Economic Surprise Index in the Eurozone is turning back up. That favors international stocks. Even the China Caixin manufacturing PMI finally turned up above 50, expansion level. Forward PE ratios of MSCI China Index. Tech sector is back to like 12 times. All other sectors are trading at like 7 times. This is an historic aberration, which is going to mean revert. GFC pushed stock allocations below the traditional 60 to 65% band. That's very interesting. So everyone's saying, oh, stock allocations are so high because they keep looking at from like the last 10 years where being above 55 looks like you're too overweight equities. But from an historical standpoint, we're still dramatically below the mean, which is 60%, and the peak, which was in 2022 of 71%. So there's a lot more to lever up. And the other thing, when you look at household balance sheets, we haven't even started the releveraging cycle that has been delevering since 2007, 2008, collapsing. There is like trillions and trillions of dollars of releverage availability coming to a theater near you, and Americans will figure out a way to tap that as long as rates go down 100, 150 basis points, which will be plenty to get them back out there relevering. Mag 7 still owned by 70% or more of funds that Bank of America tracks. They are feeling some serious pain in the last 2 months, like meaningful pain. Mag 7 earnings decelerating, other 493 accelerating. By the way, you may want to go back to that article that I wrote on June 20th. You can just go to commentary and pull up the one that has Jensen Huang signing. There you go. The next pain trade. And we talked about NVIDIA, and we talked about the Mag 7. We're going to roll over when they're trading at all-time highs, and that's what's taken place. And I think more of that to come, because if you look again here to remind you, Mag 7 earnings decelerating, other 493 accelerating. Here is the data in, I would say, black and white, but it's light blue and dark blue, royal blue and aqua blue. And you can see here the unmagnificent 493 have been flat to negative for over a year, and they just inflected positive, and they're re-accelerating for the next 5-6 quarters and beyond, while the Mag 7 peaked all the way in 2021, declined. We got that tech recession in 2022. Then they re-accelerated last year to early this year, and now they're going to decline from 50% down to 18%, and maybe a little lower if they keep spending all this money on AI chips that can't produce anywhere in line with the revenues required to make them have any positive return on investment, which means they're having a negative return on capital, which is what's crushing margins, which is what's causing their earnings to go down, which is what's going to cause their stock prices to go down in the near term, which they already have. Breadth is widening. We saw that earlier. Magnificent 7 have underperformed the other 493 by 14 full percentage points since mid-July. Okay, go back to the next pain trade article when we talked about that. Hedge funds exposure to cyclicals versus defensive sectors is just off an all-time low. This trade is re-accelerating. This is just starting. I love these extremes. And the thing about extremes, whether it's, buying, look, this was an extreme. Buying Google down in October of 2023 when it was down 50%, and October 2022 and March 2023. Look, you could have bought it at 100 and it dropped another 20% to 80. You could buy Advanced Auto Parts at 50 or 60. It drops another 20% to 40. Before you put in this base, which takes, in this case, it took 6 months. And then it was an easy double plus over the next year and a half. And it's just over and over. Citi, you could buy at 42. It dropped down to 36, another 20% against you. And then, boom, double off the lows. So this stuff happens over and over. Amazon, same thing. You could bought it at 90 or 100. It dropped to 80, 20% against you. All of a sudden, back to 200. So you just have to have patience with this stuff. If you know what you own and you buy good assets at good prices, good things happen over time. That's why you just take very limited leverage to no leverage, and you play the time arbitrage game. You don't play the trade these silly little blips up and down and get your face ripped off. You play the, I bought a great business at a good price. Now I just wait for it to recover. And sure enough, when you do that framework over and over, it works. Some of them just take a year. Some of them take 3 years. Some take longer. But the framework works over and over. I mean, 3M felt like it was going to take forever. And then when it happens all at once. This is what I think we're going to see in Alibaba. I don't know when. I think it's sooner than we all think. But, this thing took a year and a half to build a base, and then it happens all at once. And I think the upside magnitude is going to be greater. And by the way, I don't know that 3M is over, but you got to book some profits. And then, 3M drops back down to 100. We'll take another look at it. But in the meantime, we hold Solventum free of charge. Thank you very much. Last 3 months, biotech saw the largest increase in relative weight. We love that. We still own our XBI. There's another one, by the way, that's taken a long time, okay? XBI. All right, take a look at this thing. This took This one is the one that takes longer. And by the way, it's been trading kind of like the Chinese equities because they're interest rate sensitive. What's starting in the next 2 weeks? Interest rates are going down. What's going to go up? China and biotech. This looks like the BABA chart, okay? So let's just pull it up. This looks exactly like the BABA chart. Okay, so you have update. Come on, baby. Yeah, so this is wild. So you have this collapse from $320 down to $70, and then you get this rebound to $123, then it falls to $56, then it doubles to $118, and then it basically does nothing for a year and a half. It's around $80, right? Look at XBI. This is biotech, collapsed from 174 down to 61. Then you get this rally, then it grinds sideways, and then you get what? You get this big retest down like we got earlier this year, and then boom, a rally from 60 to 100, and now it's just starting to break out and recover. That's the biotech, and the same thing will start to happen, just starting to recover here. We're going to see this thing break over 90, and then we're off to the races. And it's going to be exciting because it's going to be so hated all the way up. I mean, you're going to just have people criticizing. And then I'm telling you, I remember, by the way, in June, there were big talking heads getting super excited about Amazon at $200 because it had just broken out. Okay, or I think it was 190. It just broken out. They said about buying the breakout. And that's when we were just laying the shit off left and right. The majority of the position, and sold the rest of the position down here at 180 and changed this week. And you're going to see that with Alibaba when there's a two handle on it. All the people that hate it are going to be pounding the table on it. And it's going to be fun. And we're going to start laying off in the mid 200s and hopefully some a lot higher. Moving on. Boy, we've got a lot of great stuff this week. Hedge funds exposure to utilities is elevated versus history. When we were pounding the table on utilities, no one wanted them. Now what's happened after they're up 50%? Everyone wants them. They can't get enough. It's just over. That's not it. XLU. Okay, no one wanted them last fall at $50. Now at $75, they can't get enough. I'm not saying it's over. I'm just saying that there are times to buy, and to outperform over time, you have to buy when no one else wants it. Private sector jobs at recessionary levels, stocks and credit need fresh hiring. Private X payrolls, X education and health contributions to total payroll. All right, so that's that. Bull and bear indicators not yet at an extreme. That's why I think we're going to get some strength into that first cut. We'll see. Secular bull market in commodities is just getting started. We agree, and we think this is set up to very similarly to that 2000 period, 2000 to 2007. That's when emerging markets do exceptionally well, when commodities take off. This is fantastic, this chart here. Tech, telecom, healthcare versus financial, energy, materials. So basically growth versus value. You can see, and people forget, these are normal, regular cycles. You're just blinded by recency bias of the last handful of years when it looked like the only thing that could work is tech, telecom, healthcare. But if you look back from 2000 to 2007, it only looked like financials, energies, and materials could work, while Microsoft was in the gutter and Cisco was in the gutter and Intel, all the darlings, Amazon, all the darlings were of the 90s tech boom were in the gutter, and value was going like crazy. Emerging markets, we're right at the same level. And what does that mean? is the weighting of tech, telecom, and healthcare is 44%. It hit that high at the peak in 2000. Here we are back at the peak in 2024. And what were the low levels and the peak levels for financials, energy, materials? The lows were 24 in 2000 before it got up to 44%, the same level, the magic 44. Doesn't mean this doesn't go to 50 and this doesn't go to 20 before you get the turnaround. But these cycles happen over and over again. And what I've been pounding the table is starting to be substantiated by earnings power now. And soon we will see flows with the Fed changing the regime. New orders and inventory suggest ISM is back at 52 by October. So new orders and inventories, restock cycle is picked back up. People are flying into REITs out of Japan. We covered that. The bullish indicator is not yet at extreme. This is from Slumer, markets and S&P cycles. What does best at the beginning of a new cycle? Bottoming and early uptrends. China, Canadian dollar, energy, transports, small caps, emerging markets. This is where the big money will be in the next 24 months, ladies and gentlemen. And what's finishing up their outperformance is the tech is winding down as these things are ramping up over and over. What else happens in industry group cycles? Autos, energy, pharma. Start looking at Pfizer, some of these left for dead pharma companies, food and tobacco, the Hormels of the world. So anyway, pretty exciting. Now, this chart, I'm so excited about this stuff. And this chart shows how history repeats itself when one company gets too concentrated in the index, how it doesn't last. Never has, never will. General Motors was 10% all the way back in 1968, and it collapsed down to 0%. IBM, same thing, got up to 3% of the total market cap of all stocks, collapsed down to less than 0.5%. Altria got up to 2.5% in 1993, collapsed down to less than 0.5%. Cisco got up to 4% of total market cap of all U.S. stocks and then collapsed down to less than 0.5%. General Electric hit that magic 4% in 2000, collapsed down to nothing. Exxon hit that magic 4%, 4.5% in 2009, collapsed all the way down. Apple just hit 7.5%. It's rolling over. Microsoft, 7%. We'll see. NVIDIA, 6%, starting to weaken. So history rhymes. Pay attention to the lyrics, ladies and gentlemen. Hong Kong retail sales volume index turning. So this shows the normal sequence. So everyone's saying, oh, it's weak, it's weak. It's always weak in the summer, and then it turns back up every single year. So the back half, we're going to start to see this e-commerce kick up, retail sales kick up, and people are going to say, what happened? Oh, the economy's turning. Well, there's some seasonality around it as well. Household debt to disposable income. We've been covering this. Look how deleveraged. Total debt service ratio. It's at historic lows. Okay, it peaked in 2008. It's collapsed. They can relever up all of this percentage, and the economy can boom for the next 8 to 10 years. And that's the base case as the young people take out mortgages to start families, etc. Median path of the S&P 1984 to 2023, again, more seasonality, shows a little rally mid-September, collapse, and then end-of-year rally from late October. Office vacancy rate is a record high. This is changing in some areas. I continue to say there are going to be some super wealthy clients of mine that listen to this every week that are going to figure out when and how to hold some of these higher class office buildings, not buying the marginal stuff, the B and C like the malls, they're still vacant, but the A and the B plus stuff that have 20% vacancy rates right now, I'm telling you, when the unemployment rate goes up to 4.5%, 5%, everyone is going to scurry back to work and want FaceTime with their boss. And these vacancy rates are going to go probably to 15% or 10%. And if you bought some of these properties, you're going to make double your money. I mean, it's going to be unreal. And then because you're in real estate, you don't pay any taxes, and you can do a 1035 exchange, and you're going to pull out, a few $100 million out of it. And hopefully when you make your $500 million on your next office properties, don't forget me. Send me 20, 30, okay? Diversify some of that risk after you do your office trade. All right, China valued at just 40% of U.S. markets. This is the kind of stuff where dreams are made of, ladies and gentlemen. When you can buy the mean 2 standard deviations out, and even if it doesn't even get back to the mean, you double and triple your money. And that's where we are with China right now. If it takes another 6 months, God bless. I could care less. If it happens in 6 weeks, that would be even better. Maybe I'll buy some office buildings with my friends who actually know what they're doing. Anyway, Costco, again, showing the... Costco is showing... Oh, by the way, welcome to Jeff A., who's just texting me. Jeff A. and Stephen F., who have just joined the team, doing a great job on their respective roles. Super excited to have them on board. Costco, these same tourist comp sales are off the charts. Fantastic. The total company is 5% year on year. E-commerce is up 22%. So the consumer is not totally dead. This is from Mike Zaccardi. Global EPS estimates are ticking decidedly higher. Even China, exclamation point. And China's trading at just 9 times earnings, which is the name of the game. Chinese estimates picking up, not down, up. CapEx from all major hyperscalers, $191 billion so far. This is why their margins are going down. Their spending is going up dramatically faster than their revenues, declining margins. They need $600 billion of new revenue to justify the amount of money they've spent already, never mind what they're going to spend. This is like Global Crossing laying all those pipes in the late 1990s. Eventually those pipes came to use, but by then Global Crossing was toast. Labor force growth, native and immigration contribution. Basically, foreign-born immigration is having the biggest contribution to job growth. Earnings growth. Here is again, I keep emphasizing because this theme will make you the most money in the next couple of years. Mag 7 growth went from 50% to 35% to 18% next quarter to 19%. What happened with Unmagnificent 493? -2 to 6. Next quarter will be +1, then plus 15% in the fourth quarter, and more next year. PE ratio of the top 10 and remaining stocks in the S&P 500. So if you back out the Mag 7, which are going to come down or underperform, the rest of the market is relatively cheap. 18.4 times with 15% earnings growth is 1.2 times PEG. Price to earnings growth is pretty good pickings. Weight of the top 10 stocks in the S&P 500, 36%. Again, mean reversion. Earnings contribution of the top 10 in the S&P 500 is only 28%. So they've got 36%, call it, of the weighting at the peak, with only 28% of the earnings growth. And historically, what you see is that mean reverts very, very quickly. Value versus growth in different interest rate environments. What does value outperform best in? It outperforms growth in environments between 4 to 5% and greater than 5%. So that's why we could see a situation where we only go 125 to 150 for the whole cycle, and that's an environment for like 2021 to 2027. Value outperformed dramatically for 5, 6, 7 years, along with emerging markets, which in my book is value on any metric, and dividend payers and small caps. Median path of the S&P around an uninversion. The market, the 210 spread just uninverted. If that happens with no recession. Very hard to get a recession when you have 2%, 2.5% GDP growth. This is the path which is upward. Why everyone worries is because often that happens and causes a recession. I think this time has proven, well, one, we already had the recession that everyone's waiting for in 2022. They just didn't declare it despite 2 quarters of negative GDP growth, which we've covered ad infinitum on this podcast. Technology jobs are where all the cuts are happening. You're seeing it already, 40,000 some odd cuts since July. That's going to continue. U.S. equities versus commodities at 2.5-year high. We believe commodities are just re-accelerating. There's going to be huge opportunities. Right now, we're expressed through Comstock, which we love. We have Albemarle, which is a smaller, newer position. We haven't leaned into yet, but we're actively looking for more opportunity to get exposure. Seasonality of since 1976, presidential year, we covered this. Again, rally into mid-September, rollover after. Secular bull market in commodities just beginning. We covered that. GDP growth boost due to AI will boost oil demand by 200,000 barrels per day in 5 years, 700,000 barrels per day in 10 years. We are in the middle of a rough patch. This is from Dietrich over at Carson, but the rough patch doesn't begin until the 17th. It shows the average return per day from 1950 to 2023. As you can see, all the red comes from the 18th to the 30th of September. All the green is beforehand, with a little bit of spottiness early in the month, which we saw this week. So that's data like there's nobody's business. Moving on to the quote of the weeks. From Buffett, you can't reach success in investment if you do not think independently. People could fault me for a lot of things, but no one will ever accuse me of not thinking independently. That I can damn assure you. There's no herd following here, that's for sure. Charlie Munger, a lot of people with high IQs are terrible investors because they've got terrible temperaments. And by the way, not just high IQs, but super successful entrepreneurs who get paid for massive action yielding massive results. And in our business, we have to have the discipline to take inaction. Massive inaction gets the best results. When you've done your work, you just sit on your butt and wait and don't get faked out like everyone trading the short-term noise. China's internet users near 1.1 billion. That is still a growing market driven by short videos, mobile payments. Alibaba's participating on both fronts. Alibaba wins Beijing's approval, ending years-long scrutiny. So what began with this antitrust watchdog in 2021, which caused the stock to collapse from 320 down to 56, is now officially over. This was announced on Friday, August 30th. And Baba secured the endorsement of China's antitrust watchdog more than 3 years after a landmark probe into its online behavior, suggesting Beijing is keen to signal its support for the country's giant internet sector. Amen. Hallelujah. Alibaba shares rise after it completes 3-year regulatory overhaul. Choose one, two. Alibaba has completely stopped the quote, choose one of two monopoly behavior, the SAMR said. Completed the rectification process that started in 2021, China's market regulator said on Friday. It's an interesting timing considering they're in the market buying bonds and they're in the market buying equities. It wouldn't surprise me if I'm the government, I want to use the Southbound Connect opportunity when Baba starts to move to juice that stock. If they juice the Alibaba stock, the entire world will start to flow back into China. And all they have to do is move one stock. And it's not even moving it. It's funny. Someone said to me like, See, people think that Alibaba's business has to double from here for the stock to double from here. And that couldn't be further from the truth. The business has actually grown since the stock has been $300. What you had was multiple, like unprecedented multiple contraction because of government interference, once in a 100-year event, you name it, all the bullshit that we know about is now over. So what's going to happen as earnings go up is all of these higher quality Chinese companies are going to start to get multiple, we don't even have to say multiple expansion. Multiple normalization would be a double alone with no improvement in business performance. And then markets overshoot on both sides, despondency on the downside, euphoria. So you're not going to get a reversion to the mean. You're going to get a reversion well above the mean. And at the same time, the business is going to continue to improve. They stopped Pinduoduo dead in their tracks. We saw in the last 2 quarters. If you read both transcripts, you're going to realize their competition picked up from Alibaba. Alibaba fell asleep at the wheel, and they woke up right before they drove the car over the bridge, and they said, no mas, and they went brutal, guns blazing at Pinduoduo and pushed them back. And now they're back on a run, and the game is back on. So then you get the tailwind of the economy. Then you get the government, starting to move on policy because protests are happening, et cetera, and we're off to the races. But this is a huge message at an interesting time with the Southbound Connect expected to go live as soon as next week, which means both the company will be able to buy back shares without issuing convert because they can buy them with their local currency. The Chinese government would have an easier time buying it, and 180 to 220 million new retail investors who have not been able to buy the Amazon of their own country for 10 years will now be able to own it for the first time. Their national champion, Alibaba. Only one national champion, ladies and gentlemen. Chinese e-commerce giant Pinduoduo updates rules to kick out sellers of shoddy products. This is hysterical, which basically means they will have no more sellers. I mean, you can't make this stuff up. China is trading its own bonds to stifle a runaway bond rally. Yields are going to start going up. That we talked about that. Yuan goes up, yields go up, stocks go up, yen goes up. China stocks listed in U.S. near cheapest levels ever versus NASDAQ peers. Golden Dragon Index valued at record discount to NASDAQ 100. This always mean reverts. The last time it got this low was 2014. And not only did it mean revert, it overshot. Then the same thing in 2008, 2009. Not only did it mean revert, it overshoots. This is the PE spread. Last time it was this close was again 2014, 2015, and then back in 2006. Etc. So pretty exciting stuff there. Biden. Okay, so Intel. When's the next catalyst? Number one, I think we're going to wake up one morning and someone like Elliott or some other major activist is going to be in the stock. Why? Because if they liquidate the whole company, they get their money back. If they follow through on the plan and create value, they get double or triple their money back. So all they have to do is shake a few trees and the stock will go up. So this is a no-brainer for an activist. But the board is having a meeting mid-September, according to people familiar with the matter. This is in Bloomberg. So we'll get stuff like maybe not doing the German factory, selling off some of these non-core assets like Mobileye, and there was a couple other non-cores that they talked about, and really the plan forward. And then whether Gelsinger's head goes on a chopping block or not, I don't know that that's the right move. I mean, unless they announce like just an unbelievable name, but we'll see. But change is coming, and that's a good thing, especially when you have a stock trading a tangible book. China weighs cutting mortgage rates in 2 steps to shield banks. Officials proposed rate cuts of about 80 basis points, move to boost household consumption, ease pressure on banks. Who is the toll taker for household consumption in China? The answer is Taobao, Tmall, Alibaba. China, $100 billion short against dollar enriches hedge funds. State-owned banks are helping support the yuan and and they are doing so with $100 billion short on the US dollar. Chip war. Taiwan accuses 8 mainland Chinese firms of poaching talent and stealing secrets. What did you expect them to do with the sanctions? Again, just to reiterate, all we did was take them off our tit. They were dependent on us to buy all their chips, and we said, we are not selling you chips anymore in the name of national security. And the result is now they're going to poach all the talent around the world, pay these guys 4 times. Not only are they going to poach Taiwanese, they're going to poach Americans, and they're going to get all the intellectual property. And instead of being dependent and giving us all the money, sooner or later, we're going to be giving them all the money. And that was just bad policy, short-sightedness. And, so for everyone worried about them not having the chips for AI, they already got them. Microsoft rolled out AI PCs that can't play top games, and there's no quick fix. It's the Qualcomm ARM processor chips. What's their quick fix? Notice the one company that is not in this article is Intel, who shipped 40 million AI PCs this year, the leader in AI PCs. No problemos with Intelos Chipos. So the moral of the story is they do have value and moats, etc. Here's whether they're going to get rid of Gelsinger or not. We'll see. Intel is trading at tangible book, says Thomas Hayes on Fox Business. Intel. More on Intel. Oh, working a variety of options. Anyways, and activist defense. Yuan hits strongest in over a year as flows offset fundamentals. That will be more the case after the first cut. This is what we need to see. North Face parent VF Corp sees big insider stock buy. So one of the board member, Bracken made $1 million in purchases. We know that. And former chief financial of Yum Brands, who sits on the board, bought $350,000. I mean, this guy, it's not a huge amount of money, but he's a CFO of Yum Brands, probably worth $5 or $10 million bucks. So it's not nothing. He raised Disney park prices, and fans still love him. Now he's on the CEO shortlist. This is the next catalyst for Disney. His name is Josh D'Amaro. He is an experiences master and one of the 2 key candidates for Disney. Boeing investors weigh cost of strike as clock ticks on contract. That's just part of the reason for some of the weight on the stock. They do this over and over. They'll get it resolved. If the UAW can resolve with GM and Ford, then Boeing can resolve with their workers as well, and they will with the new CEO. Biotech stocks are showing signs of life, why the rally could continue. We covered that earlier with the chart.
Great to have you back.
Jim Grant, the perennial pessimist, is now saying 50 basis cuts is more likely now. If they're going to do 50, my guess it will be on the second cut in November versus the first cut, but we'll see. No one has a perfect crystal ball. U.S. safety regulator calls for probe of Temu and Shine over deadly baby and toddler products. I mean, this thing is a complete disaster. And remember, we've been saying since day one, unsustainable numbers or unreliable numbers, it doesn't matter. The key is they're slowing and declining. BOJ board member Takata sees need to shift gears, which is code for raise rates. So as soon as the Fed starts cutting, BOJ is going to start re-unwinding the carry trade, i.e. hiking rates, i.e. unwinding the Mag 7 trade where you borrowed for nothing and you shorted yen and you bought Mag 7. Boeing says China commercial air fleet predicted to double in the next 2 decades, demand for 8830 new planes. Google is losing market share to ChatGPT, what it means for Alphabet stock. Better to be lucky than to be good. We sold the majority of the position after that pain trade article in early July. And we'll look to get out of the rest. It's not so much. I think when all is said and done, they're going to do great in AI. I think that sometimes you got to ring the register, and we'd like to do it, and we'd like to reinitiate maybe at much lower levels, and maybe it'll just keep running away against us, and that's fine too. But we got plenty of new ideas. So Boeing speeds 737 deliveries to China in respite for new CEO. Intel is we covered that. This is tonight. They're selling part of Mobileye, and also their network and edge business, which is where is that? All right. ASOS is up 15% today. We still haven't leaned into the position, but we were really happy to see that with our existing position. This thing's starting to move. We've been talking about the turnaround in UK. We've played it through a real size position in GXO Logistics, which gets 50% of the revenues over there. And ASOS in a smaller position. We are going to spend some more time and determine whether or not this becomes a serious position or just a small position. But it's nice to see some life that they got from finally selling the Top Shop stake that we've been talking about, and they were supposed to do 9 months ago. They finally did it. So that turnaround is in progress. World's smallest violin stock market and sentiment results. We covered the Kelly O'Grady last week, so thanks to Jake Mack, Liz Clayman, and Kelly for having me on. We played that in last week's podcast because we had done that on Thursday. And then we did all this. Moving on to Boeing. So these two charts are critical. And if you're listening, go to hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. My friend in Dallas got me this beautiful cup. Opinions, not advice. Booyah. Hedge fund tips. What a thoughtful, amazing gift. And then they also got me this when I did episode 200. All right. World's smallest violin. So when you look and you find this article, click on commentary or click on most popular post. It's the #1 most popular post today, and probably will be tomorrow as well. So this shows the chart since 1974. And you're looking at 50 years, 5 decades, and what you see is it keeps having these corrections, and it keeps recovering to new highs. And it keeps having these corrections, and it keeps recovering to new highs. It keeps having these corrections, keeps recovering to new highs. It keeps having these corrections, keeps recovering to new highs. And this time will be no different. Why? Because it's a duopoly, and people like to fly. And they can only get their planes from 2 companies, which have 99% of the market. Bombardier tried to do it. They got smoked. Okay, the U.S. government said, you can do it, but we're going to charge you 300% tariffs. So it tells you everything you need to know. You also see the table and the chart above are all you need to know about duopolistic Boeing. For decades, it has had periods of negative free cash flow followed by free cash flow recoveries. Negative free cash flow recovery. Negative free cash flow recovery. Negative free cash flow recovery. It has had periods of dips in revenues followed by recoveries to new highs in revenues. That's called a cyclical business, not a secular grower, a cyclical grower. Here you saw in the mid-90s, a dip in recovery followed by a recovery in revenues. A dip in revenues followed by a recovery in 2000. Dip in revenues 2004 followed by a recovery. Dip in revenues 2008 followed by a recovery. Dip in revenues 2011 followed by a recovery. Dip in revenues in a 1 in 100 year event in 2021 starting to recover. And it goes on and on. It has had periods of dips in stock price followed by recoveries to new highs in stock price. This time will be no different. Okay? So you got $160 stock that over time will be a $436 stock at least, and probably higher than that. We don't know if that's in 3 years. We don't know if that's in 5 years. So if it goes to 100, before it goes to $400 and you own it at $160. Is that a life-threatening thing? No, unless you own it on margin and leverage, or you're impatient or don't understand what you own. More likely than not, maybe it goes to 150, we add a few more shares, and then it starts to work its way towards 300 over the next 3+ years, and we make it double over 3 years, which is in line with our acceptable IRR over time. And we can sleep well at night putting size on in a position like this, because now we actually have an engineer running the company who created a 4-bagger while he did in 6 years in Rockwell Collins, which is in a similar business or an ancillary business. So that's that. Tuesday's downgrade by a short-termist sell-side analyst was comical. Quote, Boeing delays its $10 billion a year free cash flow target by 1 year from 2026 to 2027. For those slow with math, the market cap is just $100 billion right now, or 10 times 2 years out free cash flow, a 10% free cash flow yield. Here was the Reuters article citing one of the most ridiculous analyst reports I've seen in my years in the business. Annual cash flow may be delayed to 2027/2028, and it would have to raise $30 billion before developing a new aircraft, Wells Fargo said in the downgraded stock. Shares in the Dell component fell 7%. Boeing carries about $45 billion in net debt. It must address this before it kicks off the next aircraft development cycle. Cutting the debt would consume its cash flow through 2030. He goes on to say, given a likely new aircraft launch, Boeing will need to shore up the balance sheet sooner, said XYZ analyst, who is rated 3 out of 5 stars for estimate accuracy on LSEG Workspace. I wouldn't even go to a taco place rated 3 out of 5, never mind invest based on their opinion. All right. We estimate a roughly $30 billion equity raise to get back to zero net debt by 2027. Number one, is Dave Ramsey Boeing's new financial advisor? Like, who the hell said anything about net debt getting to zero? Why would you ever do that? I mean, you can't even make this stuff up. Like, this guy just got out of a Tony Robbins seminar and is walking on coals talking about being debt-free. It doesn't work that way in the real world, my man. So let's talk about the 5 points. Number one, this is the silliest statement I've ever seen an analyst put in writing. Quote, we estimate a roughly $30 billion equity raise to get back to zero net debt. Why would they ever go into zero net debt? When did Dave Ramsey become Boeing's new financial advisor? Number two, why is Reuters quoting an analyst who is ranked, quote, 3 out of 5 stars for accuracy? You can't make this stuff up. Number three, why would they start a new plane in fears of losing share when their competitor already has a backlog as large as theirs spanning a decade out for plane models they already produce? It's like, oh, let's start a new plane that we can't afford to start even though we can't even deliver 10 years worth of orders worth $500 billion of backlog. Let's start a new product. You can't make this stuff up. And furthermore, let's raise $30 billion of equity and dilute our shareholders for a product that we don't even need for a decade. Okay, common sense is the most uncommon thing. So, number four, even the analyst seeds, quote, their free cash flow could spike to $20 billion a year if they delay their next airplane development cycle. Duh, I wonder what they're going to do. Number five, I will be sending this analyst a Christmas card for allowing us to expand our position in the high 150s. We are grateful for your service. Please write several more notes so we can add more size at lower prices. And number six, total company backlog is $516 billion, including over 5,400 commercial airplanes. For those worried about the, quote, health of Boeing, may I offer you the world's smallest violin. They'll be just fine, only a matter of when, not if. And we scroll up so you can see the world's smallest violin. Moving on. Key catalyst is the new CEO, Kelly Ortberg, who started on August 8th. As CEO of Rockwell Collins, he doubled sales in 6 years and quadrupled 4x the value of the company for shareholders before selling it at a price premium to United Technologies in 2019. And so on. So then we go into a nice report from Morningstar. I like Morningstar's framework because they're all Buffettites. If you go out to the annual meetings, they're always there. They have a good investment framework. And we're running 112. All right, we could go through some of these points, but you can read it on your own. The key here is that there are only two players in town. They have 99% of the market. There's a Chinese player that's their planes go. Boeing's planes go 75% further. They don't compete on any metrics, so they'll sell a bunch of crappy planes to their own Chinese airlines. No one outside of China is going to buy a Chinese airplane. That I can guarantee you. And even the ones inside, if they want to be competitive, they got to have Boeing and Airbus. So the Chinese company will maybe take, if they're lucky, let's see, ARJ21. That's a company called Comac. They've been trying to do this for 10, 15 years. Chinese carriers took delivery of almost 30 aircraft per month on average. We have no reason to believe that ramping up the larger and more complex C-19 will be an easier process than ramping up ARJ, which has taken them, 15 plus years. And the 737 MAX 7, for instance, can travel roughly 75% more nautical miles than Comac's similar size C919, and the economics drive airline purchase decisions. In sum, the technical complexity of aircraft manufacturing is a material barrier to entry, which we believe constitutes intangible asset. Boeing and Airbus are the only two capable suppliers of globally competitive aircraft larger than 130 seats, and we don't see any global competitive new entrants entering the market anytime soon. Therefore, we believe it's reasonable to assume that almost all global demand for new aircraft will flow through the income statement of incumbents, though we concede that some Chinese demand will likely move toward Comac. Market is large enough and undersupplied enough to support two wide modes. We built a 20-year aviation forecast for deliveries, etc. Market will return to undersupplied state, that both manufacturers will continue to benefit from barriers to entry and switching costs from lack of alternative suppliers. I mean, this is a business made in heaven. They talk about the military business, etc., etc. So it's a great read there. Talk about the backlog. Talk about the outlook. Traffic is back to where it's projected. Continued growth, continued demand, continued monopoly. What else could you ask for? Earnings, Russell's small cap earnings estimates last 60 days up 2.19% for next year. This year becomes less than, we only got 3 more months left. And for next year on S&P, up 0.76%, which is also positive. So estimates keep going up, not down. Everyone's been waiting for them to go down. They're going up, up, up. Tomorrow, what are we looking for? Estimates are 164,000 non-farm payroll. So I think below 100, people would get nervous and start to price in a 50 basis point cut. I think at above 200, maybe people would get a little nervous about no cut, but they already told you they're going to do a cut. So I think you want to see a number above 164. Like, I think 140 to 180 is good, and that probably gets the market back getting bid again for the next week and a half. Below 100, I don't know. Above 250, I don't know. But anywhere in the middle, market's going to like it. All right. Podcast is over. Now we do Ask Me Anything questions. For those of you who just like the podcast, thank you for coming. We'll be back next week. For those of you who want learn a lot from the Ask Me Anything questions, here we go. Vinod Nebagauda. Thank you for your great insight and details on macro and individual companies. I also look forward to Thursday when your video cast and quick notes. It's great education for me the last 8 months. I do share the link with my friends and family. Thank you very much. That helps. By the way, if you're watching on YouTube, or if you're not watching on YouTube, go to YouTube, find the video, click like and subscribe, add a comment below. That programs YouTube's algorithm to show it to more people. More people that see it, the longer I'm going to do it for non-clients. So do that and benefit. And share it with your friends. if you got value, the best thing you can do, rather than the compliment, is email the link tonight to one of your friends that loves markets and preferably has some money. And after they listen to me for a year or two, they'll become an investor. But just anyone you can help is really what it comes down to. Okay, my question is broader view of options. You had mentioned in a call that you made 3 to 4x on options, and we've made a lot more than that, by the way, on others. To understand and learn options, how you work on call spread versus put spread, as these turnaround takes 12 months plus. If it's a client, high level knowledge. I read all the Macmillan books, options as an investment strategy. You got to learn all the Greeks, and then it's just experience. I mean, everyone wants one-year sentences. The key is start with the base knowledge. That's all the Macmillan books on options. First, you have to have the base framework. Then you have to understand markets. Then you have to understand the underlying fundamentals of the stock. And the spreads are just a way to magnify the return on an individual idea, which we do exclusively for clients. And that's the secret sauce that they get over time and benefit from. So you're not getting everything for free. Clients have an edge. And they largely underwrite the benefits that you get from the podcast. But that's where I would start. And thank you so much for watching, listening, and sharing. Frank Brown, I hope you had a great holiday weekend. Really loved listening to your recent podcast with Brendan Ahern as well. By the way, in your pod, I was laughing so hard when you mentioned I don't use Callaway while reviewing Topgolf. I just wanted your overall thoughts on Gap. By the way, I got that new driver from Crank. It's the one that Bryson DeChambeau uses, Crank Golf. It sounds like an Easton baseball bat. And what's amazing about it is because I play Mizuno blades for my irons, and I got the Ultra Jumbo grips too, the Ultra Light. Don't get the regular ones because it messes up the swing weight. And that's kept my hands so quiet, which is why I think I'm hitting the ball great again. But that Crank driver, you get away with murder, and the thing just smashes. So check that out too. I know a lot of you have picked up lap putters and are loving it as much as I do. So look, I'm just sharing my process. I'm the guy asking the AMAs when it comes to golf, not answering them. If you're following my process, that I'm just telling you what I'm benefiting from these days. All right, wanted your overall thoughts on Gap as a consumer discretionary. Oh, this is the perennial train wreck of a company. They never seem to get it right, and it always looks attractive. We did this a few weeks ago, and I said no. I'm still not going to change my mind on that. But thanks, Frank. I know it's cheap. I know all that stuff. They just seem to continually snatch victory from the jaws of defeat. Snatch defeat from the jaws of victory. Vinod, we covered you. Kayla Smith, enjoy the show. Here's an odd one. Do you have any thoughts on Western Union? We covered this one like 2 or 3 months ago. The answer was no. It is cheap. It'll probably stay cheap. It's maybe a trading vehicle up to 20, but not for me. Thanks for tuning in, and thanks for the kind words. Sam. Boeing, you like Boeing, but Airbus has a similar market cap and less debt, similar revenue also. Why don't you prefer Airbus? The only thing I like from France is their cheese. Next question. Drew Byrne, appreciate your first-class weekly content and media appearances. I keep spreading the word. Grateful for your thoughts on initiating the small QXO position. It's not that small, by the way. Don't take it that I'm... Jockey... Yeah, we bought it after the dilution. So our basis is $12.69, I think. And its liquidation value is $6.70. So I'm giving the guy 100% credit, 100% premium, because he's Brad Jacobs and he's the only guy that's ever compounded money at double digits consistently over time across 5 companies and made tens of billions of dollars for his owners. So it would be basically like saying, hey, there's a guy named Warren Buffett. If Warren Buffett started a new insurance vehicle and said, I'm going to rebuild Berkshire, I'd be interested. So this guy's done it 5 times. creates multi-baggers every time he does it. And I got to pay 2 times cash to have a free option on him doing another deal in a roll-up in the home building supply business, which is going to boom for the next 10 years because of the starter home explosion from the millennials, the biggest generation for the next 10 years. And I get to bet on the best jockey who's ever done it in history, who doesn't do stupid deals, who does accretive deals, and respects ownership, and put up $1 billion of his own money side by side. So, he's got it $2 cheaper than I do. And if you do the math, he gets 10 to 15% of the industry, which is $60 billion, with a 10 to 15% free cash flow yield. You basically have a 10-bagger over a decade. So for me, if I pay $6 or I pay $12, I'd rather pay $6. That was never on the table. Some people got in at 9 and change. God bless them. They're smarter than I am, so they got a $3 better deal. I'm paying over cash, but I'm betting on a winner. So there's nothing to think about here. So yeah, we bought it after the dilution when it fell from whatever it was, 60 to 10 or whatever. QXO. Yeah, there were some idiots when there was no float traded up to 290. When it crashed down to 10, we started building and got again at 1269. It could easily go to cash value if he doesn't do a deal. And if he does do a deal, it could pop to $20 overnight. So I like it. Next. Bob Geisman, thank you for your data and historically driven opinion. I have several of your client stocks in my portfolio. Well, you don't know exactly what my client stocks are. Your opinion on OXLC. OXLC. Oxford Lane Capital Corp, no interest in anything like this. Too opaque. You're never going to know what's in their portfolio. So pass, but thank you for sending it. John Lee, thanks for your insights as always. My question is, if you had a small sum of money, would you rather buy a great business at a fair price or an average business at a great price? If neither, what approach would you generally follow if you had a small sum of money? I'd take all that money and invest in education, because you're not going to compound a small amount of money into anything meaningful. So invest in your own skill sets, get your earnings power up so you have a large amount of money to compound. And look, I like turnaround Tom. And that doesn't mean I'm buying the best businesses. I'm just buying businesses that are down enough with a margin of safety where solvency risk is at or off, near or off the table, and then I just play the time arbitrage game and get a double or triple in a few years and on to the next. That's what I do. So you could say, oh, why don't you just buy businesses with a 20% return on capital and hold them forever? Because nothing's forever. So people are going to see those and they're going to road at their things. And, everyone looks in hindsight bias. If you just bought Monster Beverage, I mean, look at Celsius. The thing is down 75%. Same story as Monster and completely different results. So hindsight bias is very misleading. Davis, but when I buy with a margin of safety, I know can get that double or triple in a few years. In aggregate, I'll do that all day long. That's all I need to do. Everyone's happy. Davis Lung, Tom, I've been listening to your podcast for a while, enjoying every moment of the free content. Was wondering what your opinion is on Baidu's recent drop. Is there enough margin of safety for you to take a look? Yes, I'm only going to participate in China through Alibaba. I mean, I think there are a lot of risks for search. They're the Google of China, and I'm not smart enough to figure out how great their moat is. My guess is this: when China goes up, Baidu's going to do just fine and go up as well. But for me, I have outs. We talk about this every week. Poker, lots of outs. I got the cloud. I got the non-core business. I got all the AI stuff that we own that I don't even know. Every single startup, AI startup, equity's got Alibaba's got equity in through exchanging them credits with AI with compute power. So for Shippo, I've got AIDC growing at 32% a year, Taobao and Tmall turning around. So there's a lot of ways to win. With Baidu, it's binary. Their search it stays competitive or it doesn't, and I'm not smart enough to figure that out. So or predict that future. Next. talking about AutoSAR, which we covered. Do you think that the rate cuts along with dealer incentives can move enough vehicles that are piling up over ICE and hybrid? Yes, sooner or later. And the key thing is don't do it on leverage. They've got their cost basis down to a decent level. We'd rather it sooner rather than later, but it'll happen. And when it happens all at once. Okay, next is... That's it. We're done. See you next week. Same time, same place. I'll be back in New York by then. In the meantime, potential clients out in California, coffee 30 minutes in Orange County, maybe even LA County, but really Orange County. Happy to do it. And thank you all for tuning in. In the meantime, make it a great one. Bye for now.